Now, developing news this morning is the announcement just within the last hour that the US has increased interest rates 0.75%. It's the biggest rate hike in nearly 3 decades. Here's Federal Reserve Chair Jerome Powell.
The labour market is extremely tight and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in that rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet.
We're also going to hear our own GDP figures before lunchtime, which indicates how our economy is going here. Now, if you're borrowing money or if you're saving money, if you have a mortgage and you have money in KiwiSaver, then you're a bit of both, then these announcements do affect you. So here to give us some explanation and some talk about this is ASB Senior Economist Chris Tennent-Brown. Chris, thanks very much for coming in.
See you.
Let's talk about this announcement first from the US Federal Reserve, the central bank this morning. There had been a prediction that there was going to be an increase, but 0.75 seems to be the more aggressive end of what people were expecting. Is this a, we're not sugarcoating this anymore, we have to control inflation at all costs kind of signal?
Absolutely, and I think in New Zealand's case, our central bank's been signalling that for a while, and we've gone from being a bit of an outlier raising rates last year to a bit of a leader. So this process is well underway here in New Zealand, but other central banks, including the Fed, are clearly playing catch up and trying to get rates higher and control inflation.
And people might think, well, this is happening over there, it doesn't affect us, but it does, right? Because it affects their spending power, and how is it going to trickle down into New Zealand? Well,
US interest rates are massively influential, be it the Fed funds rate or their long-term rates. They influence global interest rates and they impact people's Kiwi savers. The US bond market's very important, and this thing about interest rates rising around the world and inflation is impacting all share markets as well. So it impacts all aspects of investments when the US is raising rates like this.
We are seeing volatility both over there and here, of course. Who does that affect in terms of people? If someone at home is watching this and they've got KiwiSaver or they're a homeowner, what are the groups of people that this affects?
Well, I think that there's a couple of angles. One is people that are borrowing money, probably aware that the cost of borrowing money has been going up for a while and it's going to continue over the course of this year. So that's an important thing to consider, how much your interest payments are going to be. For KiwiSavers, what they're seeing is their balances going up and down with the market volatility we're seeing. And for people in KiwiSaver, the important thing is just to focus on the long term. If you're saving for retirement in 10 or 20 or 30 years, you're going to see periods like this where markets are volatile and you just have to focus on your long-term goals.
And a lot of people are investors in the sense that they have money in KiwiSaver. There are other kinds of investors too. Perhaps people, things like platforms like Sharesies has taken off in the last couple of years. This is the first time they're going to see a real kind of dip, I guess, in a couple of years.
Well, hopefully that people, again, will focus on the long term. These things do happen. Markets were down more 2 years ago when we entered the pandemic. Share markets around the world fell by a third at that time. They're down about 20% now, which is never comfortable. But if you're a share market investor, you need to brace for this sort of volatility because it does come along reasonably regularly. And again, just focus on your long-term goals.
So in terms of if you dump stock now, you kind of miss out on the potential gains, right? So if you can stay in there, then now's a good time to do that.
Well, yeah, markets never wait for all the clouds to clear. They just as easy as they drop, they bounce back quite strongly. That's what we saw after the pandemic, and even today, markets have been rattled over the past week about what the Fed might do. They go ahead and make their announcements, and share markets are up. Well, they certainly were 5 minutes ago before I came on this cross. It's a bit of a case of buy the rumour, sell the fact sometimes in share markets on a day-by-day basis. So again, people need to think about where they want to be in 10 years' time rather than 10 minutes' time when it comes to investing in the share market.
Interesting. We're also expecting GDP figures out today. And I guess what people will be looking for is positive or negative numbers, right? It's going to tell us how the economy is performing broadly. it's going to include the first, it's the first quarter, so up until March, so it's going to include the peak of Omicron. So what are we going to expect to see from that?
Well, yeah, the economy here is going reasonably well at the moment. We've been fairly resilient. So we think the economy is going to grow about 3% over the year to the end of March. What people really worry about in this time is how's it going to go over the years ahead. And we do think the economy is going to slow down with all these headwinds. Some of them that were talked about, including rising interest rates. But over the year, economic growth is going quite well, and that's a factor behind these interest rate increases. Is that economies are growing. In our case, we're back to the sorts of levels of economic activity that we were prior to the pandemic, and so. Something like GDP reminds us that economies are growing. It's not all doom and gloom out there.
And so what for homeowners, for people with KiwiSaver, for people who want to buy a home, what does this all mean? When they see the GDP figure today, what does that mean for them?
I think it's probably a rather obscure figure for most homeowners. It's one that the Economist usually pay a bit of attention to, but I constantly remind people that the economy is actually going reasonably well despite some of the doom and gloom that we read about. We've got a very low unemployment rate, we've got positive economic growth, we've got strong export prices, and GDP captures some of that.
It is an indicator, I guess, of, or it's something that would be taken into account when looking at interest rate changes. So that would eventually filter on to people and how their money is going to be affected. Yeah,
well, the main thing that's impacting interest rates is the fact that economies are growing, but there's a lot of inflation pressure within economies, and that's what we saw the Fed responding to today, and that's what we've seen the RBNZ responding to. That, although it might feel like it, the central banks are not trying to be party poopers, they're actually trying to keep economic growth sustainable rather than having big boom-bust cycles, and with all this inflation out there, they're just trying to cool the jets a little bit.
Well, it looks like it'll certainly do that. ASB Senior Economist Chris Tennent-Brown, thanks very much for being with us.
Thank you.